We all know that Lockheed Martin is an American aerospace and defense manufacturer, but you may not know how important this company is for the US Army. There were years when they received nearly 10% of the funds paid out by the Pentagon. They created such equipment as U-2 spy plane, Blackbird, F-22 Raptor, F-35 Lightning II, Black Hawk, or Orion multi-purpose crew vehicle for NASA. So they are a super important part of the US defense system. And in today's world, the role of Lockheed Martin is only getting stronger. So let's take a look at this company, starting with the most recent financial results. Revenue is up by 13.3% year over year. Net income is down by 8.5%, mainly because of the costs of services. Cash is up by 93.5%, and debt is up by 11.3%. So those are really mixed results. But as investors, we should concentrate mainly on long-term trajectory and not the short-term swings. So let's do that. If you were to invest $1,000 into this company 10 years ago, you could buy around 6 shares, and now they would be worth something close to $2,750. And this company also pays dividends, so in that time you would get $544 as dividends. So if we add together those numbers, we get $3,294, and that is a gain of 229% in 10 years. That is a nice result. Individual insiders, that is an X. Only 0.1% of the company is owned by individual insiders. So that is not a lot, but we also should note that 11.1% is in employee stock ownership plan. So even if the management does not have its skin in the game, all the employees do. And are individual insiders buying Lockheed Martin stock? That is an X. We see mainly sale transactions in the last year. They sold shares worth around $9.4 million and bought shares worth around $250,000. So the trend is pretty visible. And do super investors own this company? That is a check. There are 4 super investors owning shares of this company. And are they buying right now? That is also a check, but the difference between bought and sold shares is not huge. Return on invested capital, that is a check at 30.5% 10-year median returns, and we want to see this number higher than 10%. So that tells us that the management is doing a very nice job. And what do we know about net profit margin? It is a check at 9.7%, and the industry average is 5%. So that shows the strong position Lockheed Martin has in the industry. And now let's take a look at share buyback. It is another check. In the last 10 years, they bought back 24.2% of their shares. So that is great news for long-term investors. And the debt? It is an X. It would take them over 3 years to pay the long-term debt with a current free cash flow. And we want to see it under 2 years. So it does not look like a huge problem, but it is a bit higher than what we would like to see. Revenue growth, that is an X at 4.1% 10-year compound annual growth rate. And we would like to see this number higher than 10%. And free cash flow growth, that is an X at 5.3% in the last 10 years. So not very impressive. And earnings per share growth, that is a check at 11.7% in the last 10 years. So here we see the power of share buybacks. The dividend yield is 2.7%, so shareholders can expect to get $12.60 annually per every share. And the payout ratio? That is a check at 44.4%. And we want to see the payout ratio somewhere between 20 and 50%, so that is very nice. We are getting a substantial portion of the company's earnings, but still the majority of cash stays in the company for growth, research, or paying back debt. And what about dividend growth? It is also a check at 7.7% 5-year growth rate. And what is probably even more important is that it is a very stable growth. So we can expect such a growth to continue into the future. It is, of course, not a sure thing, but it does seem probable. Price to earnings ratio is 16.8, and that is actually surprisingly low. It is not a small PE, but if we consider the current average price to earnings ratio in the S&P 500, which is around 24.8, then it starts to look interesting. To value this company, we will have to estimate the growth of Lockheed Martin for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. So, in the low scenario, we will estimate a growth of 6% for the first 5 years, and then 5%. In the medium, 8%, and then 6%. And in the high scenario, 11%, and then 9% growth. So the low scenario is close to their free cash flow growth. Medium is around the predicted growth of the aerospace and defense industry, which is 8.2% for the next few years. And the high one is much closer to the per share growth that they had in the last decade, thanks to share repurchases. So with such estimates, the intrinsic value in the low scenario is $359, in the medium $411, and in the high scenario $527. But we have to always apply a margin of safety to those prices. I use a 30% one, and with such a margin we get in the low scenario $251, in the medium $287, and in the high one, $369. And the current price is around $458. So it is not cheap at the moment, only the high scenario without the margin of safety is in the green. But the fact that such a company at such a moment in the world's history has any green in our valuation is actually quite surprising. Now let's open our Stock Ranking Pro and take a look at the overview of this company. So here we see all the data about all the companies we analyzed on this channel, and here we have Lockheed Martin. When we move to the end, we get the different scores of all the companies, and we see that financial health is nice, but the dividend score is the highest score for this company. So this investment can be a very nice dividend play. And let's take a look at the company overview. We can see that it is a strong company. It all looks nice, but the growth is absolutely the weakest point. But because we get a very nice dividend growth and share buybacks, such slower growth of the company as a whole should not be a red flag. So, what is the bear case for Lockheed Martin? Well, this company heavily relies on defense contracts from the US government. Any significant cuts in defense spending due to political shifts, economic downturns, or changes in national policies could negatively impact revenue. Rapid advancements in technology, especially in areas such as cybersecurity, automation systems, and space, could pose a threat if Lockheed Martin fails to innovate or adapt quickly. And what is the bull case? Well, because of threats from countries like China or Russia, we can expect increasing defense budgets and military modernization efforts. And not only in the US, but also in allied countries. And that offers substantial growth opportunities. Expanding international sales of products like F-35 or missile defense systems can diversify revenue sources and reduce dependency on US government contracts. With the establishment of US Space Force and increasing focus on space exploration and defense, Lockheed Martin's capabilities in satellite technology, space systems, and related infrastructure put it in a strong position to capture a substantial share of this growing market. If you enjoyed this video, you may find my analysis of Smith & Wesson interesting. Thank you so much for watching and see you in the next one.